Everyone, welcome to JEDi episode 20. My name is Jimmy, and with us today are Ethan and David. For those of you who tune in to our Facebook Live for the first time, and if you want to know more about us and the name JEDi, do check out our first episode in the video section. I'll be the moderator for this episode, so here's how to run through. So for today, we have a special JEDi episode about Insur-Merger. So we share this because in case you haven't read the news, there's a news about Aviva selling part of the business to Sig Life. So we thought that today is a good time to share more about the merger of insurance company, and should you be worried about your existing insurance policies, especially from Aviva? And lastly, what are the possible things to take note of with regards to the merger? Okay, so that's all for what will be shared during the fireside chat. So, and then after that, then we'll have a Q&A section. So feel free to post your questions in the comment section, and we'll address them during the Q&A section. So without further ado, I'll let Ethan start the ball rolling. Ethan?
Okay, hi everyone. I'm Ethan, the founder of PolicyWoke. So we will actually be talking about this. These are table contents. So probably in order to understand what happens when insurers merge and what are the things that we need to look out for, probably we would like to understand insurance as a business first. Then we talk about what happens when they merge and whether we should be worried about all policies or not. Because as a traded endowment business, we are fully immersed in all these policies. So I think it's good that we can address them also. Okay. So trying to understand insurance as a business, it actually comes from a very simple concept, okay, which means it is actually a social good so that no one suffers catastrophe. So what do I mean by catastrophe is when, for example, something that, let's say I got into an accident, my hospital bills are 1 million. I don't think I can earn 1 million in next 10 years or maybe even a lifetime for a lot of people. So that could be one. And how they help is everyone pays a bit as opposed to total loss. So at least you don't suffer so much if everyone pulls together. And as a business, especially in this business, is about being a middleman that takes a cut from the business. Which means to say that whatever you pay in the premiums, I will take a bit as my business costs and business expenses and my profits, and the rest will be paid to the rest who is insured. Yeah. So it's actually about the concept of risk pooling, and you can look at the premiums collected to be worth the risk that they undertook it. So it'll be like just a very simple one. Let's say I'm going to pay for 50 years and I will likely claim the amount in 50 years time. So what insurance do is to take your money, collect it 50 years, and have to ensure that the risk of the pool is big enough to give you money. Yeah, so that is how to do it. So let's say you have 100,000 coverage. So maybe because it's 50 years, right? So I divide by 50 years. So about a year, I need to collect about 2,000 from you. So that is very basic, simple mathematical calculation. But what if, let's say, the claims is much more than what I think it is? So how do I do that? Maybe I'll collect within 40 years instead. So there must be some risk buffer or something. So the history of insurance is all about when they in the seas last time, they have a lot of different types of diversification. So for example, when they are sending goods, right? Let's say I have 10 tons of fish or 10 tons of vegetables or 10 tons of gold. So instead of sending that 10 tons in one sea vessel or in one voyage, I can actually diversify it maybe across 10 sea vessels. So in the event that, let's say, one ship is hijacked by a pirate, or let's say there is very bad weather and the whole vessel sunk. So I lost everything if I were to put it in one. So that is how they actually hedge the risk previously. So insurance as a business, we look at maybe term and whole life. So it's a lot about cash flow, cash in and cash out, and even cash out for investment. So that's why you can see like term is more of a very low premium, while whole life because there is some investment component. So there's a saving component. So it's held together. So because the payouts are known, there is actually a maturity date for all these policies once they are incepted, and there is a much known date. Let's say life expectancy for a male is about 83 and a female is about 87. So they'll expect that the amount will be paid out during 83 or this 87 years later. And they also, for actuaries especially, they'll price in certain risks. For example, I may have got into an accident and touch wood, yeah, left Earth early. So that is also the risk that actuaries have to price in. So if you understand, right, that is how actuaries price all this. So these are the factors that actually affect the premiums. So number one is the number of surrender and lapse. So let's say for the $2,000 that I mentioned earlier, I collected that 2,000 from you, but 10 years later you decided that I'm not going to pay this insurance anymore. I can't afford it. So it could amount to a surrender and lapse. So instead of having to pay out this amount, right, this money will go into the pool, and this pool I can pay to others. So that will actually affect the premiums if there is a higher number of surrender or lapse. Number two is actually a possibility of payout at a different age group. So for a 30-year-old to experience death is very uncommon. Yeah, it is very uncommon in the laws of probability. Of course, for us individually, we don't look at the loss of probability, but as a business, they are looking at the loss of probability. So a person dying at 30 versus at age 85, there will be actually premiums adjusted according to the age in this case. And also pre-existing conditions, they also have done studies, actuaries, that let's say if you have high blood pressure, diabetes, and high cholesterol, right, your average life expectancy will start to drop. And the last one is actually investment returns, which is very interesting because let's say even now I think everyone who have a lot of money will be thinking, saying, where do I put my money now? Yeah, it's very difficult to find. So that's why we actually take the money that's collected by insurer, right? They also do investments so that at least they can keep up with inflation or even exceed it. So after we understand insurance as a business, you can see that actually all the risks are factored into the premiums, and the money in and money out are quite controlled in this case. So let's go into what happens when there are actually insurance that leave Singapore and actually merge. So instead of looking at that, maybe you look at two scenarios. Scenario one is nothing changed. All policies continue with their terms and conditions. However, you will need to take note that the PPF, the Policy Owners Protection Scheme under SDIC, you have to take note that in the event that maybe you have a prudential policy and maybe XYZ company actually sold their business to Prudential. So that policy could go under Prudential's PPF scheme. So it will affect the amount of coverage that you have under SDIC. Okay. For scenario two, there may be changes to the policy terms, of course within allowable areas. There may be changes in the payouts and even a bonus declaration, or even changes in the par fund management which indirectly affect the change in payout and bonus declaration. So in the case of a lot of scenarios that we see, we seldom see that happening. Okay, so let's go through three case study. So the first one is about Asia Life and Tokio Marine. So Asia Life was started in 1948, and in 2007 they changed to Tokio Marine Life Singapore. But there's an interesting fact that there was no cut in any of their bonus until recently, and even after the announcement, the cut it only affected less than 2% of all the policies that they incepted from tier date. So you can see that even if there's a change in name, if there's a change in management structure, that there isn't much changes except due to economic situation. The second case study is Zurich Life and Singapore Life. So we know that Zurich Life actually stopped their business in December 2015, which means they did not incepted new policies. And in January 2018, Singapore Life, currently now known as Sing Life, took over all the policies. So when they took over, they actually explicitly stated that there is no changes in the policies incepted. Okay, so for our case study number 3, you can see that AIA actually breaks off from AIG during the last great financial crisis. So during that time, AIG was near to the brink of bankruptcy and actually sold off the AIA business in Asia. And we can see that actually there are some effects if the economic condition is very bad and insurers sold off the business. So there are quite a number of policies affected, like the AIA Financial Guardian and those other whole life policies with dividends. So even terminal bonus was zero for endowment policies that matured that few years. So you can see that it can go quite extreme from no changes to maybe for this extremely special case because there was an economic breakdown. The terminal bonus was zero for endowment policies in this case. So after talking about all this, definitely we want to understand, should I be worried about our policies in this case? So in this particular case, we recently know Aviva actually merged with Sing Life. So all Aviva policyholders should have received a letter, including ourselves, because we held Aviva policy. So it was documented that it's only the shareholding that changed. So you can see based on the shareholdings, Aviva still retained a 25%. Sumitomo Life Insurance held 20%, TPG Investment Fund held the other 35%, and the rest with others like Aberdeen Asset Management. So will there be any impact to policyholders with this merger? This is taken from your website, and I quote, "No changes as a result of this announcement to the terms, premiums, and fees." So they did not do anything drastic. They did not change the terms. They did not change the premiums. They did not change the fees. Their customer service is still unchanged, and they still continue to operate under the same brand until further notice. So for us, this is what we think that we should do for diversification. So understanding that each economic crisis may cause a terminal bonus or maturity to have zero terminal bonus. So one, we should always try to spread out the dates between orders. Number two, try to buy from various insurers also due to the SDIC and the PPF policy owners protection scheme. Spread out your coverage between different insurers. In fact, for number 3, right, it makes a lot of sense because each insurer have their own niche market. So their coverage and their benefits are also very different. And but you do have to note that there are actually jumbo coverage policies that have discount. So David, do you still remember which insurer have this discount?
I know for me, Aviva has it.
Yeah. So that's why maybe you can think of getting a death coverage from Aviva and maybe a CI from Tokyo Marine or some other policies. So this is a way to diversify your risk. For me personally, if you look at our 5th episode where we talk about insurance planning, I did spread across my coverage between Aviva, which is a MINDEF, Aviva, group insurance policy. I have a Prudential 99 term policy, and my CI is still from Aviva. My health insurance from Great Eastern. Yeah, and even my DPS is from NTUC. So it's very interesting if you look at it in this way. So yeah, that's all for today. Jimmy?
Right. Thanks, Ethan and David, for the fireside chat. So we hope you find it valuable with regards to the merger of insurance company. So now we're going for the Q&A section. So if you have questions with regards to insurance companies, the merger, now is the time to post your questions as we are now addressing them. So any questions? No questions from the main live video so far.
Did you
Any questions from your side?
MINDEF Aviva plans?
Yes, David.
Did you all buy the MINDEF Aviva plans?
For me, I don't.
Yes, I did.
Yeah, I don't.
Was it affected by the merger?
It's not affected by the merger, but I remember it was affected previously. Okay, during the updates to the 37 CI definition. So Aviva term plan, right? They actually followed the new definitions now. So that's for the changes that if you are looking at changes to the policy terms. So for merger, not yet.
How about for the 1 million coverage? Does it give a discount?
I think that discount is locked in because if we look at what we saw, yeah, they say there's no changes as a result of this market term premiums and fees. Right? So if the discount is perpetual, they are supposed to give you Okay, I actually have a private question over here. Okay, someone asked me. Okay, they're trying to link the notion of buying a term insurance. They akin it to like buying a buying a call option.
In a sense,
So what's your idea?
except that there's also an expiry date, right? So,
Yes. Oh, have an expiry date.
yeah, except that only insurers can sell this option. Retail investors or retail people cannot sell; they can only buy. So you can only buy the option. You cannot sell it. You cannot write it.
Yep. It's a little bit like selling put options in a sense. Yeah, whereby you sell options and collect the premium. And then if the option is not exercised and it expires worthless, then the premium is still yours. Yeah. So
That one is selling. I think it's for let's say for us, right? It's more of like buying a put option,
buying.
right? Because we pay the premium, and if it hits, yeah.
When it comes to exercising the option, that's the payout already. Right.
It's the insurer that sells us the option.
Yeah,
We can
insurer sells
can't
options.
sell it.
Yes. Correct.
Okay, so that's the difference. So the similarities is like selling options. The insurers. So would it be a very profitable business in this case?
Apparently, it is.
If I mean mathematically, as long as the aggregate premiums collected is more than the aggregate payout, then there's a surplus. Yeah.
There are people who sell options as a job. That's all they do. They sell options.
Okay.
I also sell some options.
Okay, for the benefit of new people who don't understand what is option, option is actually just a right that, or it's just a contract that you have a right to buy or sell stock at an agreed amount. So that is what option is about.
Yeah. Agreed strike price and contract number amount. Yeah.
Because it might be a bit too high level for newer people.
Yes. Yes. It's one of the more advanced trading topics. Yes.
So instead of buying the stock, you buy a contract that says that allows you to get the option to buy it or option to sell it.
The most
Yes.
important thing is that you don't have to buy, you could just sell it.
Right.
Wait, I think it's easier. Maybe we just say that you can choose to write or to get the contract for buying or selling a stock. It's just an agreement to buy or sell the stock.
Yeah, yeah. Some people say selling an option is like providing insurance for people in the stock market.
Okay. In a way, maybe. Okay. Actually, we have one comment
Sure.
from Glenn. Okay. Effect of merger will only take place in the near future. For example, belief and directions. But this will be common. There is a lot of changes internally in one insurer recently as well. At the end of the day, results matter. Good results, good job. No results means there will be change in charge. Any thoughts about that?
I think that's very common.
Yeah.
So that's why stay cool. As long as it's not a bad business, you don't have to worry too much.
It's
Will you guys
like
foresee?
AIA, right? That time,
Yeah.
because of the bankruptcy in the US, then there were quite a few local policyholders who went to surrender their policies at that time, and they did not get much bonuses. So it's, to me, it's a waste of money if you just react to this when it's not necessary to react. If they had held on for just a few more years, they would be getting their bonuses.
Because of the smoothing effect, right?
Yes, correct. Because the terminal bonus is actually tied to the economic condition of that year or that few years. And if everyone goes and surrender, it is like a bank run.
It is technically a bank run, yes.
So you're not helping
The bank
yourself.
account has only so much money, right? And most of the money is invested. And if the market is down and everybody or a lot of people are selling unexpectedly, surrendering, where do you get the money from? So you can only get the money from selling your investments, which is down. So you don't get much money. And
Correct.
that's really sad for those people who are selling at the time. If you have no choice but to sell, then too bad. But if you had a choice, then it wouldn't be a good time to sell.
And moreover, there's a cost in dismantling the policy before the cash out. Yeah.
There will be a
So
penalty for the policyholder when they surrender. Yes.
it's high. Yeah.
Yeah. So sometimes if you know that you are buying any investment, whether it's insurance or any uh, cryptocurrency, for example, it's not a good time to sell when the market is down. You should only sell when the market is up, going up, or up but going down, not when it's down.
Okay.
Oh, no, when you talk about that, right, it brings me to the scenario when in March. Because I think it was quite a frantic selling that started in February, right?
Yeah, I think
You talk
so.
about the global markets.
Yes, yes.
Started in either end February or early March, depending on which stock or which asset you are referring to.
Yeah, if I look at it right, yeah, the downtrend was from 20th February. That's
Yep.
on hindsight, but if you sold it fast, maybe you would have sold it, but maybe
When you say 20th February, you mean the peak, right?
yes,
So anytime from 20th February to 27th February would be a good time to sell because it is
yeah,
very close to the peak.
correct. You if you wanted to sell, you have sell during that time. If you
Yeah.
reacted, if you
Uh,
reacted very
sell
badly
like
when
1 month later when you are at the bottom, then you think, oh, I should start selling. That'll be a bit too late.
yeah, but that's for fundamentally bad companies. If you want to sell fast or you want to take a profit fast, you
Well,
want
you
to
only
protect.
invest in fundamentally sound companies.
Yeah, so I think that's something that we need to take note of for this case. So even for insurers, it's the same.
I think all insurers in Singapore are fundamentally sound.
Correct. So, talking of being sound, we have another comment from Glenn. Says, buy term in simple is like buying Toto. At the end of the day, stay calm and do not panic when changes take place. Okay, I agree. What about you guys? Fair enough, this statement.
To me, it's like buying a long dated call option. So you expect to live until maybe 80.
Hmm.
You can buy your term until 60, 50, 40, maybe in different at different ages, so that you have less protection over the years as you grow older. So obviously the amount that you drop in terms of insurance will mean that your liabilities drop or your net uh, net worth has grown to allow you to self-insure. So yeah, it's a long dated call option. So those that are shorter uh, tenure, like 20 years, 10 years, are very cheap. Those that are 30 years, 40 years, 50 years, or up to age 99, those are expensive. So I'll say buy the cheaper ones if you can.
Okay, cool. Okay, thanks Glenn for your comments so far. Actually, I have one last question. Maybe for both of you. Do you foresee even more mergers in the future? What are your thoughts?
When
Given
you
the
say
current
near
state,
future, how near are you referring to? Maybe a time frame.
maybe another 2 years.
We might
What do you
have
think?
one or two more, I presume, because there's quite a few changes in the digital finance landscape in Singapore. So who knows? Maybe if Apple thinks that Singaporeans should be included in the insurance industry, maybe Apple will come in. Now Apple is already going into um, the health industry with the Apple Watch.
Hmm.
So before long, you have um, telemedicine. Maybe you have insurance for Apple.
Yeah,
If you can
if
track
you
your health, right? Why not they just do insurance because it's all linked. And if they know how often you take MC, for what reason, they know your health, they know your heart rate every day. Insurance is just a small step away.
Hmm. Right.
Yeah, it's very true. In fact, if you look at how actuaries price their premiums and how they get their model out, right? It's actually based on all these studies. Right? They're actually studying your health based on past experiences. Then they do they plot lah. They plot a curve and see what are the probability. And they price all this into the premiums.
Yeah,
But
and
if you ask,
maybe you would have personalized insurance depending on a lot of data, like for example, where do you go? How long do you stay at certain spots? How long do you stay at home? Uh, how long do you engage in physical activities? All these affect how the insurer can uh, personalize your insurance for you. And everyone will have a different pricing because everyone's risk is different.
that's under big data and analytics already.
That'll be fun now when you have more personalized insurance. And then people, when they see, oh, this actually affects my financial health over the long run. Like if I, for example, if I climb stairs instead of taking the lift, and my insurer knows that, and that allows them to give me a maybe a lower insurance every month. That might affect our daily habits.
Yeah, for merger and maybe newer players coming in, right? Actually, you can see if you realize Tokyo Marine is actually a Japanese insurer, Great Eastern is a local one. If you look at Prudential, is from US, if I'm not wrong.
US, yeah, US, yeah,
Yeah, so there are actually quite a number of players who knows like in India, maybe.
maybe.
Yeah, in India, insurers might come in also. Oh, I think David, you mentioned about Korea also, right?
Well,
Oh,
in
Korea.
Singapore, we have a lot of people from India, from China, from Korea. So we really have China companies in Singapore selling insurance. Why not India? Why not Korea?
Yeah, so it depends on whether they want a piece of the market share and whether they think that our high net worth in Singapore is worth insuring.
The thing is, if their high net worth is coming to Singapore, then maybe they will come over.
Yeah, that should probably answer your question for new insurers. For mergers, it depends on it's like why Aviva want to get out of here. Lah. So it depends on their reasons really.
Okay, guys, we have a comment from Chun Wei that yes, India have we have a insurance company called LIC, which in Singapore for a few years already. Yeah, so India have.
I was thinking more towards like maybe Tata Industries, right?
Oh,
LIC is not really well known. Maybe their marketing budget is not there yet.
possible. Yeah.
So there's really a lot if you're looking at this.
Cool.
I have this
Okay.
bank account from ICICI. It's not very well known, but pretty good foreign currency fixed deposits.
Hmm. ICICI. Okay.
Okay. I think there's one in Paya Square, right? Is it? Or
I think
I
Ang Mo
remember
Kio branch
wrongly.
have one, if I remember correctly.
You mean
Yeah,
the branch, is it?
Yeah.
branch.
I
I remember
only know
seeing it
the
in Ang Mo
Raffles
Kio.
Place one.
Oh, Raffles Place. Okay.
It's usually empty.
Oh, that one is ICBC Bank. Yeah.
Ah,
So there's actually some not less well-known banks that is from other countries also coming in. So
I think
if
it's
we are
from China.
financial hub, ICBC.
Is it from China?
Sorry.
Is ICBC from China?
Yes.
They have a branch in
yes.
Chinatown also. I saw it.
Ah.
I was thinking of applying for their credit cards, but it was it was not good enough.
Um, yeah. So we are going to a globalized world, so it really depends on where they want their business to be situated in.
When their high net worth come
Right.
over, they'll come over.
Okay.
True, they go where the supply and the demand, the supply and demand dictates where they will be.
Hmm. True.
Yeah.
Okay. Okay. Got one more comment from Chun Wei. That LIC is the biggest insurer in India, but not focusing yet in Singapore. Yeah.
Yeah,
Yeah. That's
interesting.
all. Okay. I think in the interest of time, we going to end this episode. Okay. Okay, right. Right. Thank you guys for tuning in and all the comments you have for us. Feel free to post more questions in the comment section, and we will address them during the next episode. So, speaking of next episodes, we are going to announce that uh, the next one, which will be next Friday, 5 p.m., JEDi episode 21 will be our last episode for the current education series. From 2nd October onwards, we will launch the more advanced education series where we will share about how to life hack your own finances. For details about the advanced education series, stay tuned to our Facebook page as we will share more details later on in the next week or following week. Okay, so on our last slide, there's this QR code where if you scan the QR code, you have access to our landing page where you can check us on website, Facebook, YouTube, and Telegram channel. If you join us on our Telegram channel, you have access to the resale insurance policies that we have. So if you would like to know more details about these resale insurance policies, do contact us on our Telegram channel and we will get back to you. So if you like our content and be notified for future episodes, do like our page and share this post. So we will see you next Friday, and
May the
Make
may
the
the
finances
finances
you
be
with
with
you.
you. Alright, goodbye.